So today I've got a couple of updates for you guys, what's going on out there. We've got the inflation news, we've got some individual stock news that we're going to go through as well. And also I'm going to share with you a big mistake I avoided. And sometimes you see the mistakes that you make, or sometimes you guys see the mistakes that I make, but never the ones that kind of like, wow, that was a close one. Like I said, oh, that's worrying me a bit, and I don't like that stock because of this situation. And obviously, the ones that get identified are the ones that you don't notice, and then I suffer from it, that I buy that stock and it's down. But there's a couple of times that I'll talk about a stock and go, I don't like this because of this reason. And if I didn't notice that, I would have been suffering quite a bit this week with one stock. It would have really hurt. And I'll point that one out for you guys, and hopefully it helps you guys improve as investors. That's why I always share this kind of investment journey with you guys. That's why I first started making videos. 9 years ago now, or however long it was just to share with you guys the reasons why I like a stock. And then eventually it kind of turned into what the research I've done to share with you guys. Like, this is the research I've done on this stock. Here you go, have it for free. And then you guys, that if you're looking to that stock, maybe it helps you out. And then it just kind of came like a point of view, like what I'm buying, what I'm selling, what I'm seeing out there in the market, and it just rotated a little bit. So it's kind of going back to the early days of the channel, really. But anyway, inflation news. Inflation news came out. Market didn't like it. S&P's down 1.1% today. Nasdaq's down 1%. Russell's down 2.5%. The small caps get hurt a little bit more because it is inflation related, and what the small caps like is a predictable and a low interest rate environment, and inflation isn't going down. There's a worry around the interest rate cuts. But the S&P is still up 8% for a year. That's still a cracking year overall. So yeah, I think I've said for a while, I think it's good for the S&P to have a break. I personally think the S&P, as much as people don't like me saying it, I think it'd be very healthy for the S&P to not do anything for the next kind of 6 months. And I know for me that makes no good content, because what do we need to have good content? Where you have a stock market going up a lot, where you have the stock market going down a lot. Those are where the best views come, personally, for me. But realistically, for my investments and for your guys' investments, it'd be very good for the market to have a bit of a cooling off phase. The valuations were starting to get a little bit frothy. You look at some of the key indicators out there, some of the new investors that are getting attracted to the market, the investors going to buy the stocks that were buying, Bitcoin and the hype around Bitcoin. You normally see that when it's around a frothy market. It was starting to get a little bit worrying out there. So I think a cooling off phase won't be the worst thing ever right now. And even though I know a lot of people don't want me to say it, 6 months of doing nothing would be very good for the stock market right now. Just let those financials catch up a little bit to the valuations. We don't want to get too stretched. We see it when we get too stretched. Look at 2021. It's an example where stock prices got too stretched to the financials, and eventually it's going to have the reality check, and the reality check is going to hurt a lot more, and we don't want that to happen. So yeah, I mean, we'll see what happens. That's my thoughts anyway on that. Inflation data came in a little bit higher than was expected. 3.4 was expected, came in at 3.5. Obviously the market freaked out that it came up in 0.1%, a lot higher. But yeah, overall, the big thing is to zoom out, and when you zoom out, when you look at the trend has basically been sticky now from around about June time last year. We've basically nearly coming up to a year now of where it's been sticking. I'm quite surprised, because I thought that we would see a nice tick down into that 2% range, and it's not really happened. A few things just keep going up. Shelter's always been one of the things that just keeps going up and up and up. I think sometimes at some point it has to start going down. Whenever that point is, I don't know. When you look at the energy, obviously then you get the combination that you were hoping that by the time that shelter calmed down, energy can then start going up again. But it hasn't happened. Energy has started going up a little bit more recently, and that's also put a big impact on it. I think the big half of the increase this time around was energy and shelter. So those are the two root causes, really. So you've got a shelter that's just not coming down, and then we've had what we didn't want to happen, which is now energy has started going up without that shelter flatlining yet. So yeah, it's it's not terrible. If it's going to be sticky, it's better to be in the 3% rather than the 4%, 5%, 6%. It's only 1% off. But we just wanted to see it in that 2%, because then we could start having the cuts coming in. That's probably the reason why the stock market's rallied so much this year, is that because we have been predicting the cuts. The market was starting to predict cuts at the start of the year, and now it's knocked it back to June. And I personally thought the cuts will come in June, but looking at the data right now, if this inflation is not getting down to that 2% range, don't know why the Fed would cut. I mean, the economy is getting weaker out there, and it's a bit worrying, to be fair, because the economy is getting weaker out in the US market, and the cuts at some point do need to come. However, the Fed could probably stay at these higher rates for a bit longer. It would hurt us a bit as investors. They could stay here for longer, but we don't want them to do that. But if it's at 3%, are they probably going to do that? Maybe. So it's a bit of a tricky situation that's kind of building up here in the background, and ultimately that's what I've said, is that for me, this is why my kind of key priority in the last kind of couple of weeks has kind of shifted now to building up cash. For so long, through 2022, 2023, even some parts of 2021, because if you remember, all small caps crashed in 2021. The bear market started for them 6 months before the full market. When you look at a lot of that time frame, it was literally cash deployed. Like, I basically had no cash balance. Everything that I had went straight into the stock market. And in 2023, especially towards the back end, it started to slow down a little bit more, and where I've actually started to build up a cash pile. And my cash pile sitting at probably a good 5%-ish now, 6%-ish now maybe. But I'd like it to be 10%. And my cash pile, I think, should get to 10%, because if we're going to have a big correction where everyone kind of goes on, hold on, we thought we were going to have interest rate cuts this year, and actually we get no interest rate cuts, I think the market will throw its toys out the pram a little bit, and that could create an opportunity. And if it is going to happen, I need some dry powder just in case, and that's why I think I've been trying to be maybe a little bit more cautious on the cash pile side of it anyway. But getting on to what the point of the video was today is avoiding an opportunity. Like, wow, Perion Networks. I think some of you guys might have seen me mention this on the YouTube channel. I think you guys on the Patreon as well. I think at some point we did a full video on it on the Patreon. Perion Networks, this stock was very, very interesting to me. It was a stock that I was looking at and I was liking what I was seeing. The valuation wasn't, I mean, it's currently 5 times earnings right now. The valuation wasn't bad. Historically, the company had been on fire in all cylinders. The growth had been pretty impressive. The profitability had been pretty impressive. Financial health-wise, decent balance sheet, no debt on there, a lot of cash, as you can see here. And I was thinking this could be an opportunity. So I had a look into the stock, and after looking into the stock, there was a few things that kind of came up to me that were making me a bit nervous about it. So the first one is understanding the business. Overall, I felt like after doing a lot of research on it, I feel like when you buy a business, you could be a lazy investor sometimes, go, yeah, that looks all right, I'm going to buy it. You can't do that with individual stock picking. You have to know the business in and out. And I feel like that I could actually go in there and work there. And if I could explain to someone very well what the business does, every part of the business. And I felt like with Perion Networks, even though I've looked into it so long, there were still parts of it I didn't understand. And there was parts of it that I was worried about. So I was looking at this Microsoft partnership, and I didn't understand the full in and outs and what the connection was and how secure that connection was. And it made me a bit nervous around this partnership that they had with Microsoft. And also, I think a lot of the revenue came from Microsoft as well, which I was like, that's kind of worrying. What also made me worried is that it seemed like they had a very similar partnership with Google. And the partnership between Google ended, and it seemed like that hurt the business as well. On top of that, there was also a management change going on. And you can see here the partnership around Google back in 2013. Also, what made me a bit nervous is the management team. The CEO walked away, and not that just because the CEO is leaving, it's the end of the world, but it was a bit like, it's always when the CEO's been in there for a long time and they then choose to kind of walk away, it's kind of a bit like, is the business okay? There was also the management change that was kind of going on in the background. And anyway, came out the other day that Microsoft are making changes that makes up a lot of the revenue, and that's going to affect the business. And you can see here the guidance went from 590 to 610, from 860 to 880 million. So big impact on the revenue, and that actually led the stock to go down nearly 40%. And actually in the last kind of yearish, really, the stock would be down 66%. So if I bought this stock, I'd be sitting down massively on this stock right now. And I thought it was one of those that I kind of like share with you guys, that I looked at this stock quite a bit and I walked away from it. And that's what sometimes you have to do. It's frustrating sometimes where you spend like 2 days researching a company and then you go, I'm not going to buy it. Sometimes it happens. You spend those days looking at it and a lot of time and you walk away with it. It can be a pain in the ass sometimes when you've done it. But sometimes you've got to do it. And it came down to me where I just went, I still don't understand the business 100%. And sometimes you got to walk away from those opportunities. If you're not confident, you got to walk away sometimes from those opportunities. And even though everything looked okay, just because I didn't have that knowledge around the company, I just can't do it. Because if you don't have 100% on confidence in the business, then there's plenty of there's hundreds and thousands of stocks out there. Don't force yourself to buy a company if there's something that you don't like about it. And that was what happened with Perion. I just went, there's something I just don't like about this business that I've got to walk away from it. Whether it be the CEO change, or if it be the Microsoft changes, that I didn't have full knowledge under the business. Because at the end of the day, if the stock starts dropping, I've got to have the confidence to buy. I've got, if you look at the likes of Hims and DraftKings, when those stocks were dropping in 2022, I could come on the YouTube channel quite confidently and say, these are still amazing. I'm still buying the dip on these. And I explained every negative case about the business. If there was a short report about the business, I came on the YouTube channel and I took apart every part of the bit and explained it to you why I don't agree with it. The YouTubers, I mean, everything money. A YouTube channel that had 20x audience my size came out and said DraftKings was a bad business. And I made a video, I think twice, picking apart every bear case why they're wrong on the stock. Now, obviously, DraftKings from that time frame has gone on to 4x, 5x in share price, and I was right on those businesses. But the only reason why I was able to do that is because I had 100% confidence on the inside, the outside, what was going on in every part of the business, the financials of the business. I knew it in and out. And as an individual stock picker, that's what you got to do. You got to buy what you know. And I was just forcing myself to like Power Networks. And I just eventually went, I've got to move away from it. And that's a prime example why. Now, don't get me wrong, there's a couple of times and also it's worth pointing out as well is that My Wall Street. So these guys are a platform that charge for their stock picks. I can't remember how much it is a year. I think it's doing like £1,000 a year for the platform now. But My Wall Street as well, who have a cracking record of crushing the S&P 500. Look at the record here. Compared to the S&P 500, 413% return since 2017. Compared to the S&P's 98% return. Forex market there. But even one of their big stocks was Perion. So I had these guys saying, oh yeah, we really like Perion. I was like, there's got to be something here. I like the financials. They are picking it as well. And they've got a cracking record in the market. And I just went, I still can't buy it. Because at the end of the day, if I buy this and it goes down, I don't know what I'm buying. I'm questioning what's going wrong here. I can't go to My Wall Street and go, hey, you guys, you pick this stock. What should I buy some more? You can't do that. And sometimes I notice that in the comment section as well. Sometimes I notice people comment on like, oh, you bought so and so and that stock's down. It happened like, when DraftKings was down, oh, you bought DraftKings, it's down. What do I do here? Like, if you're investing into it, you have to know the business and know why you bought it and have the confidence if you're going to buy the dip or not. You've got to know what you're buying. And also it shows you that even these guys that have good track records beating the market, you are going to from time to time as well pick some stinkers, unfortunately. That's part of investing. I think that a lot of people don't realise that. I think that a lot of people don't realise when you do this individual stock picking game, you can even still do all the research and sometimes it just doesn't work out how you expect it to work out as well, which is key to say. But also, what I said here is that sometimes you're seeing things that you don't like and you walk away. Don't get me wrong, there's a few times you do that and actually the investment works out. But it's better to be 100% sure than get lucky, Another one was Pragmatic. I was looking at this business around about a year ago and I was like, I just can't get my head around the business model and I walked away from it. And in that time frame, since 2023, I mean, the stock's done amazing, especially in the last couple of months. The stock's rallied up massively. But if I did buy it, I probably wouldn't have bought the dip. This stock here had a major dip. It dropped to nearly 37%. And I don't even know if I would have bought the dip there because I probably didn't have the confidence because I didn't know the business. So I had to walk away from that one. And once again, I had one of my favourite YouTubers out there, Ali's World of Stocks. He was posting videos saying, oh, I'm buying up Pragmatic. And I was like, Alice Wells really likes his business, and I really rate him as an investor. And I was like, should I be buying this stock? And once again, probably should have bought this one, but I'd rather be 100% sure, and I just wasn't. So it does work both ways anyway. So just thought I'd make a video on that, because you don't need to buy everything out there, guys. You buy the ones that you're 100% confident on. You don't need to buy the ones that you're 80% confident on. It's better to be 100% sure on it anyway. Last one. InMode. Thought I'd really quickly mention InMode stock. Probably not worth doing a video on its own, but it had a pretty big drop the other day. The stock's down around about 3% since Monday, but it has been on a downtrend for the last while, really. Down 50% year to date, so stock that's underperforming the market at the moment. Came out with their preliminary results, and they were crap. There was no other way to put it. The full year outlook was lowered to 485 million to 495 million from the consensus, so it was downgraded by about 10 million on the low side and 10 million on the high side. The big thing was the Q1 guidance. They said that they expect now revenue to come in between 80 million to the 100 million guide. They guided down by 20%. So yeah, that's a big guide down. It's, to be 20% off your guidance on your revenue basis is big. To get that wrong is surprising. I am very disappointed. Like there's understanding that sometimes the quarter doesn't work out you're expected. The last 4 weeks massively dropped off, but to be off that much is a horrible guide for a business. What also made me worried is that they knocked 20 million off the guidance, but only knocked 10 million off the full year. Like it didn't move in line. So in their full year guidance now, I know they sandbag the guidance normally, not this time around in Q1, but that's expecting also some rebound in the back end of the year. I was like, shouldn't that full year guidance be moving in the line? And looking at that, I mean, if the company's going to be 80 million-ish a year, and this is one of the stronger periods, I don't think they're going to be anywhere near the guidance they're giving there of that full year guidance. So yeah, I'm worried about this guidance, and I also think the guidance was, I'm not sure on them numbers. And I was looking at InMode and I'm going, listen, at the end of the day, I can understand why they're struggling. They sell high expensive, non-invasive technology for appearances. So right now, doctors don't want to pay big money out to go get them. They're being a bit cautious about it. The interest rates they would have to go buy it at are a lot higher. But also for them, they're probably seeing a bit of a cool down on people that are coming in, because right now people aren't going to go out and pay for these big treatments to be done because of the tightening economic environment that's out there. So their customers are suffering, that are stopping them from ordering because of the economic environment that's out there. I can understand why they're suffering. The guidance I thought was very poor from them. I think to be off was quite shocking. But what frustrates me more as InMode is that right now, if this was 8, which it is, it's 8 times earnings, I could sit right now and go, you know what, if your profit and revenue stays in line at these sort of numbers right now, I'm okay. You're staying in line in this environment. It's okay. What frustrates me most with InMode is that, if they do go back to a bit of growth, bit of profitability growth at 8 times earnings, this is good. And if they weren't growing and they're throwing off this amount of profitability every year, you're throwing off 200 million a year, and your company's valued at 1.5 billion, I'd be like, you know what? For a company at 8 times earnings, 1.5 billion valuation, throwing off this profitability, through this tough environment, I can sit on my hands a little bit and go, I'll wait until the environment improves and then we'll see where we're at. Like, it's fine. What's frustrating from InMode's point of view now is the balance sheet, because your stock has been absolutely crushed. You've just stitched your shareholders up by giving them a horrible guide, and I think even your guidance is probably incorrect here. You're stitching your shareholders up a little bit, but yet you're still throwing off 200 million in profitability. You've got on your balance sheet 741 million of cash, right? Let's say by the end of the year, that's probably going to be more towards at least 900 million, towards nearly $1 billion. You've nearly got a third 2/3 of your business in cash right now. And I know they've been saying we're looking for an acquisition here. We don't want to spend the cash because we're looking for an acquisition. Fair enough. You know, I can understand that. But you've been doing that for a year and a half now. And I know they don't want to do share buybacks. But at some point, when your stock is trading at 8 times earnings, and you can, for under a year's profitability, you know, if they throw off 200 million in profit, let's say they throw off 150 million, that's 10% of the market cap. They could right now go, you know what, shareholders, you're stuck with us for the last kind of 2 years basically now, with our share price doing nothing. In the last year, you've took an absolute battering. The environment's pretty weak. We believe our shares are very cheap at the moment at 8 times earnings. We can buy 10% of our market cap right now. We don't believe in share buybacks, but you know what? We're going to give you some. We're going to buy back 10% of the market cap. I don't understand. You know, if for them it's no issue. It's about 6 months of profitability. Even if they're going to do a buyback, realistically this year, they're still going to have, because they're going to make up nearly 150 million. They could do 150 million buyback, and it's only 9 months of profitability. They're still going to have 741 million in cash. They've still got 500 million plus free to go buy a business, and that's a business a third of the size of their current business. Like, they have the ability, and even though if the management team don't want to do it, they've got to do something for the shareholders right now. They've got to. I don't understand why they don't put 150 million share buyback out there. They could buy 10% of the market cap back right now at these prices. And that would at least help the shareholders through this year, through this tough environment. And then by then, in a year's time, the financials are probably going to be recovered if we're in a low interest rate environment and the shares start going up. Like, I don't understand why they don't do it. I don't understand why they don't do it. It's absolutely crazy to me. And for me, from a shareholder point of view, when you know, I've been in this business for a while. You know, I've been up on this business over 400%. I was selling some of the business out at 400%. And I see the stock right now, and I look at the management team right now, and I go, what are you doing? Like, I would normally be all over buying this InMode dip, but I'm not. And that's worrying to me that I'm thinking that way. That I'm worried, like, what are the management team doing out here? You know, they're giving these guides, which are absolutely terrible. They're sitting on this balance sheet with all this cash. They've got the company trading at 8 times earnings. They can buy a 10% of the market cap, and it wouldn't even scratch the balance sheet. And they just sat there. I'm really surprised, because I never thought I'd be in a place in InMode where I actually start questioning myself, going, how can I buy more shares with this management team in place right now? Like, I feel, I looked at the guidance that the management team just given, and I feel really disappointed as a shareholder that they've given that guidance. I feel really disappointed. I understand that there's the economic environment out there right now where they're at, but you've got to be guiding better than this. And if your share price is getting slumped like this, you've got to protect your shareholders. And I don't know, it's losing a bit of patience with them a little bit. And I guess, you know, from an InMode point of view, you know, the shares have basically done nothing for 2 years. And I don't want to sell right now because it feels like it would be selling at the bottom right now. But I just feel like the management team need to step up here. So I think they're doing a conference call. I think it's the 2nd of May or something. So I'll probably listen to that when it does come out. But that, yeah, really disappointing. Really disappointing. I never thought I'd make a video on InMode saying that, you know. And yeah, I'm down. I think I'm down on InMode like 15% right now. And there's a part of me, you know, really thinking, if I haven't got the confidence to buy at these levels, you know, why do I hold it? You know, go buy something else. And I can't believe I'm saying that about InMode, but I shouldn't be saying about it, because right now I feel like as a shareholder, I should be going, you know what, yeah, it's not done anything for 2 years, but it's 8 times earnings, the cash they've got there, I'm going to, you know, if it was a dividend, a share buyback, and then we see how it recovers. You know, at least management team are protecting the share. It just feels like management kind of like don't care about the shareholders right now, which is where I don't want to be right now for business. So yeah, a bit disappointed from that one at the moment. So thought I'd be all over this dip, but I'm not really, which is quite surprising. So it's definitely, just wanted to say that InMode's definitely in the doghouse as well right now. Anyway, so anyway, I'm calling that video there. It's a long one. I thought this was going to be like a 10-minute talk, but we were like over 20 minutes right now, which is which is long really. So anyway, hope you enjoyed the video, guys, and I'll see you in a bit.